Hello, everyone, and welcome to SCORE Fairfield County's live webinar on using financial statements to make your business successful. I'm Peter Talion, the webinar coordinator and a business mentor here at SCORE Fairfield County, and I'll be your host. Our speaker today is John Harmon. More on our speaker in just a moment. First, some brief information on SCORE. SCORE is a nationwide organization of about 240 offices with over 11,000 volunteers. We are part of the Small Business Administration. In Fairfield County, we provide service by 100 volunteers, business mentors with a wide range of experience and expertise. We offer 3 primary value-added services to small business owners. Number 1, we provide free one-on-one counseling, face-to-face, telephone, email, and video, which can be accessed via the Request Mentor link on our website or via the link on the screen. Note, we currently are not doing face-to-face mentoring until further notice. Number 2, educational workshops and webinars, about 100 a year, and you are watching one of those today. Number 3, extensive resources on our website, including a network of subject matter experts at your disposal. We have converted some of our in-person workshops to live webinars due to COVID, but we are now doing some in-person workshops. Look for the specifics at fairfieldcounty.score.org. Some useful information about today's event. If you have a question, please use the chat window at any time during the presentation, either the chat window or the Q&A function at the bottom of the screen. Our webinar will end at 1 p.m. to respect your time. The session is being recorded, and the link to the recording will be available at fairfieldcounty.score.org within the next couple of days. Now it's my pleasure to introduce our speaker, John Harmon. John is a SCORE volunteer at Fairfield County. He is the managing director of Agilent Consulting Services, which advises small and medium-sized businesses on strategies for growth and operating excellence. John has held senior leadership and executive positions in sales, marketing, quality management, strategic planning, and new business development at Eastman Kodak, the Gartner Group, and Pitney Bowes. It's now my pleasure to turn it over to John. John, it's all yours. John, you need to go off mute. The mute button is at the bottom left, very bottom of your screen. Take your cursor down to the bottom of this. If you take your cursor down to the bottom of the screen, all the way to the left, you'll see the mute button. You can unmute there. John, can you try again? Go ahead, John. Nope. Now go ahead, John. John, can you hear me? We cannot hear you. All right, I'm going to, why don't you log off, John, and log back on again. We're going to have the presenter log back in again, and we'll try it. Apologize for the delay.
Okay, I think I'm here. Can you hear me?
Yes, we can.
All right, I'm not sure what happened. This is the first time I've encountered something like this. But I'm sure you'll all be patient with me as we start this, and apologizing for the delay. So let me begin by making a couple of comments. First of all, this material is probably best for those who are in business. Although if you're not in business, there are some things in here you should keep in mind, and much of this material will be relevant as you get deeper into your business. Second of all, in my experience, many people, many business owners in small business don't really use their financial statements the way they should. Maybe they think they're not operationally relevant. Maybe they're a little afraid of the concepts, but I can assure you none of this is difficult and all of it's important. So what in the world would I expect from my financial statements? Well, one of the things is you can understand the key contributors to your profitability. What is it that makes me profitable? It could be costs, as we all imagine, but it could be price. It could be a failed strategy that you haven't fully captured in your financials, but there are some things that are not necessarily obvious, but which the P&Ls and the balance sheets will make clear. Are my costs in line with my business model? The consulting business model is different from, say, construction, where the gross margins for consulting are much, much higher than the gross margins in construction or in retail, for that matter. And understanding what your business profitability numbers are can help you better understand whether you are above or below the curve in profitability. Cash flow. This is such an important thing. Sometimes business owners don't manage their cash flow as well as they should. They're not even aware of their cash flow statement. And we'll talk about P&Ls versus cash flow statements in this presentation. Financial risks, what are they? There's such a thing as working capital. We'll talk more about that. But your working capital ought to be positive. And sometimes it's not obvious that that's the case unless you burrow a little deeply into your balance sheet and compare your liabilities to your assets. What are the trade-offs between financials and business strategy? We're going to talk a lot about profitability. We're going to talk a lot about the things that are financially important, but it could be that your business strategy calls for you to have a higher than usual cost structure now in order for you to invest in the future. So any rules we have around profitability need to be modified by your business strategy. Well, and speaking of that, what is the financial value of my business strategy? If I project out my business over the next 12 or 18 months, what does that look like? What kind of business does it appear to be in 12 or 18 months? And finally, particularly for those who are interested in selling their business, what is the business worth? How do I value my business? And the financial statements are an important component of that answer. The agenda, we're going to talk about the basics of accounting. We're going to talk about the three important financial statements: profit and loss, balance sheets, cash flow. We're going to talk about how the statements interact, common problems, and then we're going to talk about some financial ratios, how you can look at your financial statements and compare one data item with another to determine whether you are on the right track or not. So there are three income statements, or sorry, financial statements. One is the income statement, or the P&L. This is simply a running record of your company business transactions. You do it on a daily basis, weekly basis, monthly basis, but it will allow you to understand what transactions have occurred in your business, what sales have occurred, what expenses have occurred, and finally, what is your net profit. So that's the income statement. Most of you are probably familiar with this. We'll talk a little bit about how you structure an income statement and how you use it in a few slides. Second of all, the balance sheet. This is a snapshot in time. There's no such thing as a balance sheet which covers, say, the year. You might look at the end of the year balance sheet, or you might look at a July 1st balance sheet, but it's always a snapshot in time. And it consists of what your assets are, what your liabilities are, and what your net worth is. And by definition, your net worth is the difference between your assets and liabilities. And finally, the cash flow statements. We'll talk a little bit about why a cash flow statement is different from a P&L, but cash flow statement simply recognizes the cash that come into your business and the cash that go out of your business. And it's not necessarily sales, which you'll register when they occur, but not when you get the cash. Positive cash flow means cash remaining for other things. Negative cash flow means you got to come up with cash from some other source. And finally, a cash flow statement will allow you to understand the seasonality of your cash accumulation. When does it go up? When does it come down? When are you in danger of not having enough cash over some period of time? Some basics in accounting. I'm going to try to make this relatively straightforward and simple. First of all, there is such a thing as cash versus accrual accounting. The IRS, by the way, allows you to submit your taxes either on a cash basis or an accrual basis. And what that means is accrual is tracking a transaction when it occurs. So in the retail business, often that's the same thing as cash. You make a sale, you get the cash for it. But in a lot of businesses, particularly B2B businesses, the service you provide or the thing you sell, you don't get the cash from for another week or two or month or several months. And expenses are the same thing. I might acquire, say, some inventory now, and it goes on my balance sheet as an asset, but I don't recognize the cash until I actually pay for that item. So those two things differentiate a cash versus an accrual accounting approach. The IRS will allow you to do one or the other. You can't switch in the middle of the year. You could go from a cash basis in one year to an accrual basis in another. You just have to let the IRS know what you're doing. Recognizing revenue and expenses. Sometimes this is relatively simple. So if I make a sale of, say, a meal, I'm going to get the cash right away, and it's easy to recognize the cash when I get it. On the other hand, if I am in the construction business or if I'm in the consulting business and I have a project that takes over, say, several months, the question is, when do I recognize the revenue for that? Do I recognize it at the end of the project, which could mean months and months? Or do I have some way of recognizing that it has gone through several stages, and at each stage, say preliminary, mid-stage, end stage, I'm going to recognize the revenue? We'll talk more about how this works, and in some cases, it will require an accountant to help you determine when you recognize revenue for a particular kind of a transaction, but it's important that you do that. And same thing with expenses. There's something called a chart of accounts. Every P&L is based on the chart of accounts, and that's nothing more than a list, a designated list of revenues and of expenses and of costs. So as an example, I may have 3 different kinds of shoes that I'm selling. Well, rather than having one big bucket called revenue, I may very well want to have 3 different revenue accounts, one for big shoes, one for medium-sized shoes, one for large shoes. But still, I want to recognize the different kinds of businesses and services that I offer, and I want to make sure that my chart of accounts reflects that. Same with costs. The easiest example would be marketing. Marketing is a cost, but there are lots of different kinds of marketing. I want to make sure I have a term that captures those different kinds of marketing. So for instance, trade show expenses might be a marketing. Website development might be a marketing cost. Advertising might be a marketing cost. Marketing strategy might be another marketing cost. Just make sure that you identified all those particular kinds of marketing and have a chart of account descriptions that reflects that. Incurring an expense versus buying an asset. Expenses, by the way, are those items that have a life of less than 12 months. If they have more than 12 months, then they appear on the balance sheet, either as an asset or a liability. It's a simple way of understanding an expense versus asset. Expense appears as an item on your P&L. An asset or a liability appears on your balance sheet. We'll talk a little bit more about the interaction of those in a few slides. And finally, depreciation, amortization. Depreciation is a recognition that if I buy an asset, let's just say a car, and this car has an initial value of $10,000. That's $10,000 that appears on my balance sheet as an asset. And every year I use that car. Well, every year, and let's just say that the car has a 10-year life. So every year, in effect, I've used 1/10 of the value of that car asset. So after the first year, that asset, which was $10,000, becomes $9,000. And that $1,000 then appears as an expense on my P&L. Same thing with amortization. Those could be startup costs. There could be other kinds of asset costs. We'll talk more about that. But these are, in effect, cash expenses that don't require cash, but still appear on your balance sheet, or sorry, on your P&L. Here is a standard income statement, simplified, but still, every income statement looks more or less like this. First of all, at the top, there's revenues. And what you want to try to do is divide those revenues up into discrete elements. So for instance, I may want to designate my revenues by customer, or I may want to designate by market segments, small customers, large customers, shoe customers, dress customers. But it's important that you try and identify a discretionary description of each of those revenue types of sales, because some of your products and services are going to sell more or less than others. And you want to try to recognize the dynamics of those sales by how you structure them on your income statement. Cost of goods sold in the service business or the consulting business, these are relatively small, but cost of goods sold are simply materials, which is to say, if I'm selling, say, bottled water, the water itself that I procure or I make is going to be material. The labor I use to procure or make it is a labor, and then shipping and handling. All those things come at the cost of goods sold. And when I subtract cost of goods sold from revenues, I come up with something called a gross margin. Again, the cost of goods sold are those costs directly and immediately impacting customers. And you want to try to manage this for cost and quality. You don't necessarily want to try to reduce the cost of your materials or reduce your labor, because it may have a negative effect on your customer. You want to try to manage those costs separately and differently than you do the rest of your expenses, which I'll get to in a minute or two. The gross margin is your basic profitability. It's the basis for all of your profitability. If your gross margins are too low, then it's unlikely you'll ever make a profit. And these gross margins, as I might have mentioned, will differ by industry. So in the construction business, gross margins are in the 25% range. In the consulting business, they're likely to be in the 60 or 70% range. The expenses in consulting are going to be much higher, and the expenses in construction are going to be much lower. But at least I'll understand what my gross margin looks like, and I'll understand how it compares to the industry, the industry models, industry gross margins that I'm operating in. So then we move to expenses. These are expenses that don't relate necessarily to the direct development or creation of goods and services for the customer. They're things like marketing or rent or travel or facilities or whatever, all those that can't be identified with a particular sales transaction. So when you subtract your expenses from your gross margin, then you are left with your operating profit. This is another very important way of understanding the profitability of your company. Obviously, if your operating profit is negative, your net profit is going to be negative. Taken out of those operating profit are interest expenses and taxes. And so that's the bottom line. Once you take off interest and taxes from your operating profit, that's your net profit, and that's the profitability of your business. The balance sheet is the next financial statement. And this is simply a statement of what you owe or what you own. It always appears in this format. On the left-hand side are assets, and those are subdivided into current assets. These are assets that have a life of less than 12 months. So they include cash or accounts receivable or inventory. And then there are fixed assets. These are hard goods, computers, furniture, equipment of one kind or not, machinery. All of those assets are fixed, and you add up the total, the current and the fixed, and you come up with your total assets. And as I mentioned before, these assets are going to have a life, and every year these assets are going to be reduced in value because you're using them every year. And there's always some deduction that you're taking every year because of depreciation. You're also adding that as an expense to your P&L. On the right-hand side are liabilities and equity, and they're further subdivided between current liabilities, and those are liabilities that have a life of less than 12 months, or long-term liabilities. So a current liability would be accounts payable, or some what you're paying in the way of interest in your long-term debt. And your long-term liabilities consist of any loans you've got. You add up your current and long-term liabilities, and you subtract that from your total assets, and you come up with your net worth. Now, almost by definition, startups are going to have a negative net worth. Why? Because you're just getting started, and you're probably not going to have a lot in the way of assets. You're going to have a lot in the way of loans or other kinds of liabilities, but that's the nature of things, and that's fine as long as you have a plan in order to move toward improving that net worth until it's positive. Cash flow statement is like a checkbook. So at the beginning of every month, I have a cash balance that I start out with. I have money that comes in from sales, and then money goes out from things like my cost of goods sold, operating activities, loan payments, whatever. And then I subtract the outflows from the inflows, and I compare that then to the current cash position, and I come up with an end of the month cash position. So in this case, I started out with $15,000 worth of cash. I had $37,000 coming in. I had 62,000. That's 62,000 going out for a negative cash flow for that month of 24,000. So my cash flow for that month is a negative 9,300. That means I got to come up with $9,300 worth of cash somewhere. And then that negative, in this case, I'm just assuming it's going to come from a line of credit. So I take $9,300 out of my line of credit, and now I have zero cash going into February. And you do the same thing over in February, March, etc. And in this example, you see that every year my cash position improves. So I'm cash positive finally in March, and I continue to be cash positive all the way through June. Many business owners don't pay enough attention to their cash flow statement. And this is a big mistake, because you don't want to operate blind when it comes to running your business without cash. So here's the interaction. I've got an asset, and the asset in this example might be inventory. So the inventory then is applied to the P&L. I make a sale, I generate money from the sale, and that cash from the sale goes directly to my cash flow statement. If I am not collecting money for that sale, but it comes in the form of an invoice or later receipt of cash, that collected money goes into the balance sheet as accounts receivable. That's an asset, but it's an asset that my customer controls. And I want to make sure that I get paid for what I've done. Many businesses, or at least more businesses than you would imagine, don't manage their receivables very well. And as a result, they're often in a cash poor position. So you can see sales will go either directly to cash flow statement or to the balance sheet as uncollected. If I reduce my debt, my reliability, that will also affect my cash flow statement. And all these things then operate together. You probably should be looking at your P&L no less frequently than a week, certainly every month. It's not that important that you review your balance sheet maybe once a quarter, but not that frequently. And your cash flow statement, you ought to do that every day. So each of these three things interact with each other in the following, in the way that I've depicted. So what are the problems in managing these accounts? Well, you could have a poorly structured chart of accounts. I've mentioned, for instance, that if you don't have the right kind of term covering the right kind of transaction, you may miss it. You may lump it into a larger set of activities that are very difficult to manage. I've mentioned marketing as an example. If you're spending $1,000 a month in marketing, you don't know, and specifically, what you've spent your money on within that category, unless you have a chart of accounts that reflects that. There are, and this is true usually with companies that have bookkeepers, it's important that you distinguish between a cost of goods sold and an expense. It's important that you make sure you register a particular sale in its right revenue category. If you're not applying the right number to the right transaction, you could have a P&L that is not reflective of actually what's going on. And which gets to the third point. If you have a bookkeeper, make sure that they understand how you've structured your books. Make sure that you're watchful about how they're doing. It could be early on, you want to be very watchful. Later on, maybe it's not so important. There are sad cases where bookkeepers do whatever they want if you're not looking, and that can occur. I have a client that lost $80,000 because They weren't watching what their bookkeeper was doing. They weren't reconciling their P&L with their bank statements. All of that's important that you understand and that you keep watch on. We've mentioned the insufficient revenue and profitability detail and insufficient tracking of balance sheet. We're going to talk more about what that looks like in a few slides. And then finally, insufficient management cash flow. It is critical that you understand what your cash flow statement looks like, anticipate when it's going to be negative, have a plan for what that looks like, and to see your cash flow positivity going up over time. Okay, so we are now in something called financial ratios. These are little aids to help you figure out what your financial statements are telling you. There are profitability ratios. Mostly of you have heard most of these, but we'll talk more about what they look like. Liquidity, which is to say, how do you cover your debt? Are you able to cover that debt? Are you at risk of not being able to recover that debt? How does that look? And then finally, efficiency. How do you convert an activity, a sales activity into cash? Or how do you turn an inventory into cash? We'll talk more about how that works in a few slides. Profitability. We've already talked about gross profit. It varies widely from industry to industry. If you're in a particular business, I would simply Google what a gross margin looks like for a particular type of business or a particular type of industry. If I want to know the profitability of a jewelry retailer, I can look it up and simply through search engine activity, inquire what that looks like. It's important you understand where you stand within your industry, and you're unlikely to be hugely different from what's going on in your industry. You might be the best within your industry, but you're not going to be hugely different. Operating profit, we talked about what that looks like and how you calculated it. Net profit. Return on assets. This is one that is probably not that important for businesses that don't have a lot of fixed assets. But it certainly is important if you're in the construction business, or if you use equipment, machinery to produce the products for your customers. You want to make sure that your assets are contributing to the profitability, or the extent to which they are. My example would be if you're in the pizza business and you're delivering that pizza, you want to make sure that you have relatively efficient, low-cost asset to do that. Bikes, in terms of asset profitability, asset contribution, bikes are a lot better than Mercedes-Benz if you're in the pizza business. And again, this will vary widely by industry to industry. Google what that looks like, and you'll find out what your industry typical average is. And then finally, fixed asset turnover. How much do your assets contribute to sales? So here's a P&L for a particular, this is a catering business. You can see in this case, they have identified different categories of revenue: themed events, plated events, sit-down events, buffets, hors d'oeuvres, etc. And each one of them has a different contribution to revenue. In this case, the most revenue, that is the plurality of the revenue, is coming from plated events. The least amount of revenue is coming from celebrations. Now, that by itself may not be meaningful until you begin looking at the cost of goods sold and what each of those contributes. So, for instance, in the plated events, it's a 60% cost of goods sold, or in this case, a 40% gross margin. Well, the themed events have a greater, have less cost of goods sold than plated events. So in terms of sheer gross margins, themed events are more profitable than plated events. Now, it may be that the possibility of getting themed events is much less. You want to make sure you understand that if you increase your themed event revenues, you're going to be increasing your gross profit. So we have itemized items within revenue. We understand those cost of goods sold. We understand what each of these is contributing in the way of profitability. In this case, the gross profit for this business is about 42%. Turns out that in the catering business, 40% is not bad. 45% is pretty good. That would be terrible if you're in the consulting business, but for catering, it's just fine. Then we have our sales, general, administrative expenses. And as you can see, the total expenses for that are $340,000. That eats up almost all of the gross profit. So at least on the surface, it would appear that their administrative expenses are higher than they should be if overall operating profit is the goal. Now, it could be that in order for you to grow, you need to have high salary people in order to generate the kind of quality you need, in order to attract the kind of customer you want. And that's fine as long as that's your strategy. But if your strategy is you have a business that's fairly stable and operating profit becomes very important and your administrative costs are too high, then the question is, well, what do you do to manage those? In this case, because of their high administrative costs, operating profit is almost zero and net income is zero. So it's worth looking at to see what kinds of changes this business might want to make. Here is another example of profitability. This is two examples. One is your return on total assets. In this case, you take total assets divided into the revenue and you come up with, well, what do they contribute? In this case, it's a 2% return on your sales. That's not very good. So the question is, well, why is that? Maybe these assets are building up for the future and you're quite willing to have a low number like this, or it could be that you need to think about how you begin paring down your assets to make them more efficient. And then what about the assets' ability to generate sales? In this case, they're pretty good. For every dollar of fixed assets, I generate $4 in revenue. It's just that because of my high administrative costs, my return on total assets is not very good. Liquidity. This is a measure of your risk. This by itself is not necessarily a reason to close the business down, but it does give you an idea of what risks you face. There's something called a current ratio, or otherwise known as working capital. And this is your current assets divided by your current liabilities. In this case, if you have inventory, that ratio ought to be 1.5 or more. If you don't have inventory, it may be closer to 1. But if it's negative, what that says is, if for some reason you lose a big customer, or if for some reason one of your suppliers wants to get paid immediately, you may be at risk of default because you have a negative working capital number. This is not something you look at daily, but it's something at least to consider over every quarter to half year, and then determine what you want to do about it. Your business will continue to exist. It's just that you are facing a little bit of risk. Then days of cash. Many conservative accountants will tell you that you should try to have 6 months worth of cash to cover your expenses. That's quite a lot. But at the very least, you ought to be looking at a month. So look at your expenses over a month. Make sure that you have revenues to cover those expenses over a month, and you'll be safe. Otherwise, you could, again, fall victim to a loss of customer or some unexpected cost that you hadn't anticipated, and suddenly you're in negative cash flow range. Here's another, this is an example of liquidity. So in this case, we have our example, we have $15,000 worth of cash. That means they have a little over 6 days worth of cash. That is pretty risky. You could run into big trouble if for some reason something happens you didn't anticipate. The current ratio is not too bad. In other words, if you compare current to assets to liabilities, it's much better than 1.5 to 1. It's 4.5 to 1. So in that sense, the working capital is good. It's just that you don't have enough cash to cover your anticipated expenses. If I look at accounts receivable, I see it's over $100,000. That means that instead of having $115,000 worth of cash, you got $100,000 that your customers have and are sitting on, and you're not being paid for the work you've done. That's an important thing to worry about and consider. Efficiency. This is the extent to which your assets are contributing to cash. So we've already talked about accounts receivable. It's called day sales outstanding. But what you want to try to do is compare how many days of revenue do you have in receivables. Generally, ideally, you want to try to have day sales outstanding of 30 days or less. In other words, your receivables are equal to about 30 days worth of cash. In some cases, you don't have that kind of control. It could be that you are serving large customers who will pay you, but they may have some kind of a payment policy that says they're not going to pay suppliers for 45 or 50 or 90 days. This is particularly true of hospitals. It's not like you want to walk away from these customers. It's just that you need to help, you need to manage this cash flow and understand how to optimize your receivables. Same thing with days inventory outstanding. How much inventory do you have? And again, you want to try to, there's a huge variability here. So in grocery store business, the days inventory outstanding is relatively small, and the turns, that is the number of times that a particular inventory item turns over in a year, is above 10. But in other businesses where the inventory is relatively stable and not utilized, it may be much less. The key is to have just enough inventory to cover your needs over some short period of time, 30, 60 days. Having too much inventory ties up that inventory in cash that you can't generate in the way of sales. Having too little means that you're in danger of stocking out. Days payable outstanding, this is the extent to which you are able to pay your suppliers. Many small businesses play a game, pretty serious game, between managing their receivables on the one hand and managing their payables on the other. Sometimes suppliers will tolerate a late payment. Sometimes they won't. And understanding how you can manage your suppliers and the payment schedules you honor for them is part of business policy and a part of managing the nuances of your business. And then finally, cash conversion, that you add your day sales and inventory outstanding, you subtract your payables and come up with the amount of cash you have converted every month. Now, I will have to say that even though I've introduced you to all these ratios, pick a couple that are important to your business. Don't try to manage them all. And it could be that over time, the ratio you select will change. Here's another example of efficiency ratio. So in this case, day sales outstanding is over 40 days. That's bad. It ought to be better. Inventory is not too bad. It's 25 days. It's not too bad. Payables is pretty good. I might even recommend that this company not be so quick to pay off payables in order to compensate for the high receivables. But these are all business decisions that a particular business must make. let's see. Don't think I want to get into that, but I will say this. There are some practical uses of financial ratios. You want to use your cash flow statement as a leading indicator of your financial strength or weakness. I mentioned this, pick a few ratios that are relevant to your business. And this is one of the areas where your SCORE mentor can be helpful. They can look at your financial statements and say, the biggest thing you have to worry about is receivables, or the biggest thing you have to worry about is a working capital problem, or whatever. But your SCORE mentor can help you understand the most important ratios and to select the right ones. And I mentioned the most likely key ratios are gross margins, net income, day sales outstanding, which is receivables, and a positive liquidity. When you're selling the business, there's a different set of assets that come, ratios that come into play. So a prospective buyer wants to understand what are your assets and how do they contribute to your profitability or to your sales? What's your return on equity? And how would I value my business? Typically, business valuations are done by taking an extension of your current P&L and projecting that out over some period of time, 3 to 5 years, what that looks like. And that's usually the basis for evaluation. That's a seminar unto itself, but it gives you an idea of how the financial statements are critical in order to come up with some idea of what your business is worth. Finally, even though we've talked about all these financial ratios and the good ones and the bad ones, ultimately, this is your choice about what kinds of financial ratios you're willing to tolerate and how that reflects your business strategy. If I am in growth mode, I am more likely to have a higher cost structure in a way that I'm investing in my future than if I'm in a current business that's stable and not likely to change. The dynamics are not likely to change. I'm not likely to grow that much. And all I'm trying to do is to manage for profitability. So marrying your financial statements with the ratios and with your business strategy is the best usage you can have of your financial statements. That tells me that we are 10 of 1. Peter, is that timely?
That's right on the money, John. Thank you very much. We have a number of questions from our listeners. If you have a question, why don't you post it in the Q&A space at the bottom of your screen. But let's get started on the questions that have come in so far, John. The first one comes from one of our listeners. For a solopreneur providing a service, do we need all the spreadsheets you mentioned?
Well, the quick answer is yes. Now you use them differently, but yes, you should have a balance sheet, you should have a P&L, you should have a cash flow statement. Again, it depends on how frequently you use them and what you make of them, but don't ignore the financial statements. Together, they give you an idea of the financial characteristics of your business. And after all, if you're in business, you want to understand how the business operates.
Okay. Related to that, the question from another listener, when should a business let the IRS know what type of accounting system the business intends to use, cash or accrual accounting?
This can be done before the end of the tax year. Talk to your accountant about the specific time. The IRS needs to know, what's the accounting approach that you're going to be using for this tax year, and to let them know before the end of the year. And you can change that. So next year I may move from cash to accrual. It'll drive you a little nuts. It's probably bad business practice, but there are certain reasons why certain business want to change that accounting approach. Just let the IRS know before the end of the year.
Okay. A related question: can a CPA or a registered agent assist with setting up books for a startup consulting business? Any recommendations for accounting software that isn't too complicated?
Well, the answer is yes, they can be very helpful. They can be helpful in setting up a chart of accounts. They can be helpful in determining the right levels of depreciation you should be expecting. What's your asset worth? What's its useful life? How do you apply that to a depreciation schedule? These are just examples. And while I should make one more statement. Some accountants are what I call tax accountants. Their main job is to prepare tax returns, and that's fine. You want them to do that, but you may also want an accountant, and these where SCORE mentors can come in useful to help you understand how the financial statements help you understand how your business is running, how it's operating, what kinds of things could you be doing now to most efficiently run your business. That's different from tax accounting. In terms of accounting packages, I would recommend that you get one. Please don't use an Excel spreadsheet, which gets real complicated and very difficult to manage. QuickBooks has an online version, which I've used and find relatively simple. They also have a desktop version. There are other packages out there. Usually they are relatively cheap, in the several $100 range, and they are specialized for a type of business. So an example in QuickBooks, you can buy a package for a retail business, which will have a list of chart of accounts items that are consistent with what retail businesses use. There are also packages for manufacturing businesses or for service businesses, consulting businesses. But there are a variety out there. They usually specialize by type of business. They're relatively cheap. And there are, if you don't want to try to do it yourself, there are training programs out there to help you use a particular accounting package. I would recommend strongly that you do that, that you buy an accounting package and use it. It also allows you to link your accounting package with your bank account to make reconciliation a little easier. And it's important that you make sure your books are consistent with what the bank is saying. Otherwise, you'll be in trouble at some point.
Okay, thank you. Our next question, can you give a little bit more definition on what goes into cost of goods sold for a service-based business?
Okay, so in service, the primary component, the primary thing you are delivering to your customer is your time. And that could be on an hourly basis. It could be a project basis, but time is a big factor in coming up with cost of goods sold. You have very little materials, although you might be selling such things as training manuals, in which case that goes into cost of goods sold. You may be offering some kind of an online information service, which would go into cost of goods sold. But the primary component of every cost of goods sold item in the service business is labor. And how you calculate that labor, there's a little bit of judgment to have to make. I mentioned if you have projects that last months and months, you could identify that service as completely occurring during the end of the project. So you wouldn't have any mention of revenues during that time. But I usually recommend that you try to establish stages in that business so that you know that if you've completed stage one, you can recognize that as revenue. But it's mostly labor.
Okay, thank you. Our next question is, how does one derive a value for the allowance for bad debt on the balance sheet?
Well, that's a bit of a judgment call. So if I have receivables that are older than, I'm making this up a little bit, but if they're older than 3 months, then the likelihood of you collecting on that, even though you've tried, is small. In which case you say, well, it's bad debt, sorry, I'll write it off. And that appears as an item on your balance sheet. You don't want to have this happen often, but and it varies by industry. But I will tell you that If you're writing off about 10% of your receivables as uncollectible, you're probably in the ballpark. It's not a happy ballpark, but at least you'll know you're within some kind of an industry standard. I would Google to come up with bad debt ratios, just to get an idea of what your industry looks like.
Okay, we have a few minutes left. We'll keep going. The next question from one of our listeners: what vetting questions do you recommend for hiring an accountant?
Well, first of all, make sure you know what you're getting. Are you a tax accountant or are you a business accountant? Most accountants are tax accountants, and that's fine, but at least you know what you're getting at. I would also ask them, what industries do you serve as an accountant for? Accountants specialize, as many professionals do, and some accountants specialize in the construction business. Some specialize in retail. You might, if you're in a, especially if you're a unique business, ask the accountant what kind of businesses they have as customers. And do they specialize, or are they more familiar with accounting in a particular business or industry than another? Other than that, it's just references. Who are your customers? Ask them for a name or two and call the customer up and say, well, what do you think? They're not going to give you bad names, but at least you'll have some idea of what you're getting into if you understand whether they're a tax or a business accountant, what industries they're in, and what their references are.
Okay. Our next question is, would you please recommend a resource, a book or a video to follow up as a review of the information covered today? I will tell our listeners that this session is being recorded, so you can go back and listen to any or all of this recording. But in addition to listening to the recording again, do you have any favorite books or videos, John, that you would recommend?
I do not. You can always go on YouTube and browse what you find there. I don't have a particular reference I can give you, but I'm sure they're out there.
I will also mention to our listeners that the SCORE website has got literally hundreds of different seminars, webinars, resources, templates. So the SCORE website, our clients have found, is a tremendous resource for additional information, different perspectives and different views, exactly along the lines of what John said.
Yeah, and I have to add, Peter, often advice is so specific to the business or the industry that you're better off seeking out somebody who knows the business. And to my mind, there's no better source than a SCORE mentor. They can help you understand, first of all, what your financials should look like. They can look at your P&L, your balance sheet, and give you an analysis of what that looks like, suggest changes, suggest strategies in the use of those statements. So general training courses are fine, but often it's much better to have it specifically tailored to you, your business, and your business intentions.
Okay. Someone asked a question about whether there'll be a link to this presentation. This will be available for replay. Give us a couple of days to get it up on the SCORE Fairfield County website, but the audio and the link will be available on the SCORE website. We had another question in terms of John's contact information, and John's contact information is also available on the Fairfield County SCORE website. You can communicate with him directly or request an opportunity to talk to him as a SCORE mentor. So we've come to the end of our time together. These are great questions. We very, very much thank all of you for participating. Check our website, fairfieldcountyscore.org, for information on upcoming webinars and in-person workshops. We also use and look at the evaluations that will be sent to each of you at the end of the webinar. We look at the comments to make our webinars better and stronger and more useful. So in closing today, a great big thank you to John. Excellent work, John. We really appreciate it. And we wish all of our listeners a great, safe afternoon. Thanks, everyone. That concludes our webinar.